Welcome to the Treasury Update podcast, presented by Strategic Treasurer, your source for interesting Treasury news, analysis, and insights in your car, at the gym, or wherever you decide to tune in.
Welcome back to another episode of the Treasury Update podcast. Today we are sitting down again with Paul Galloway, Senior Advisor here at Strategic Treasurer. Welcome back to the show, Paul.
Thanks for having me, Brian.
Absolutely. So AI is all the buzz today, and we're going to be talking about AI, but we're going to be talking about it in a particular area, and that is foreign exchange and interest rate risk management. So let's get right into it, Paul. Tell us, what are some of the key risks associated with managing FX and interest rates?
That's a good question. Definitely got to lay the ground of what the risks are. Otherwise, just talking about how AI might help manage it doesn't, you don't have good context. So we think about, what are some of the market indicators or factors that have impact on both foreign exchange and interest rates. And certainly one area that I think a lot of people are paying more attention to nowadays is geopolitical uncertainty. We have the Russia-Ukraine war. We have Israel and Hamas, who are currently in a ceasefire truce. We'll see if that holds. But there's other things going on, such as trade wars between the U.S. and China. There are other factors that pop up from time to time in other countries where they're having challenges with their own currencies. Such as Argentina. Recently, we had done something to try to help prop up that currency so it didn't fail. There's certainly reasons why that's happening, but it just goes to show that there's uncertainty out there that have impacts on both interest rates and currency. Another area is around market liquidity. Like to understand, what are those factors that have an impact on liquidity. In a more liquid environment, there may be incentives to have people want to borrow or exchange currencies depending on what's going on in the markets today. And market liquidity can be impacted by credit quality. It can be impacted on by what is going on with Fed decisions and certainly those wars that happen out there. And so a lot of folks that are looking to manage foreign currency and interest rate risks are paying attention to these, along with nowadays we have a lot of conversation around Fed decision making. Are they going to lower rates? There's been certainly a lot of boisterous action from the current sitting president that the Fed has acted too late and they should have dropped rates sooner and had bigger drops than what they have. But you have to pay attention to what's going on. So there's noise out there, but you got to pay attention to what policies are by government leaders, your central bank, what kind of impacts that might have on interest rates. And so not only do we in that arena, do we track interest rates, but we also look at what's going on with currencies. Currencies can be very unpredictable at times. There can be a certain level of volatility. And so the U.S. dollar is often compared against other major currencies around the world. It's tracked. Trying to predict what's going to happen can be challenging. Some folks will say, well, just look at the current spot rates. Current spot rates are going to tell you what's going to happen in the future, but spot rates are very near term. It's what's going on now. Very difficult to understand what's going on with future rates 1 month, 3 months, a year from now. That's super challenging. So you got both short-term and long-term aspects that you have to think about, both for interest rates and foreign currency. So what this all means is that what's important to organizations that are trying to manage this risk is, one, the ability to forecast. Forecasting is super important. And then you have to manage monitoring all these key factors or drivers that could impact what the future looks like, the direction that currencies move, as well as interest rates. You got to keep your arms wrapped around that, and to do that can be quite challenging. And so in today's environment, there's a lot of focus on what's going on with tariffs. Tariffs is another way of saying tax. There's a tax on goods that are coming in to the U.S. in the form of tariffs, in the sense that as those supplies are being shipped into the U.S., a tax is put on those goods coming in. A lot of folks had expected cost to increase as a result of it, and there has been some increase of cost due to tariffs. So there is, pricing uncertainty can have an impact on what's going on in the economy. Certainly central bank policy as we look at interest rates. And so all these things, whether it's interest rates or foreign currency, at the end of the day, being able to forecast what's going on and predict what those key drivers are, short-term and long-term, are really key. It's hard to manage all that information. It's a lot of data, a lot of data points, a lot of historical information that can perhaps give some directional idea of what's going to happen in the future, but it's not necessarily true. The uncertainty tied to interest rates and FX can be different than uncertainty tied to the stock market and what it's going to do. So you're looking at some factors that are a little bit different than perhaps what you might look at for a particular company in the stock market. So at the end of the day, managing those risks can be a challenge.
Okay, so we have a host of dynamic variables, a host of risks. What are some of the key aspects of managing those risks?
Great question to ask. So when we think about managing FX risk, a lot of times it's synonymous with hedging. So hedging meaning that you're trying to protect yourself against a movement in either foreign currency or interest rates. And that could come in a variety of ways, but let's just think about what hedging objectives are. The hedging objectives is kind of rolls in a circle. So you want to protect cash flows, you want to stabilize earnings, you want to reduce FX and interest rate uncertainty. So how does that happen? Well, you got to start with some kind of risk framework. So organizations that have a framework in place, it's established policies, it's limits, it's governance, it's tied to things that impact these risks that you are trying to manage. And so what that does is it sets the tone for exposure management. So you've identified the risks, so you have to understand what's the quantity or the amount of change in these risks that are potential out there. Current position relative to what you expect the future position to be. And if you're looking at, you're not only looking at sensitivity of key drivers, but you're also looking at scenarios. What if interest rates go up? What if interest rates go down? What happens if the US dollar weakens or the US dollar strengthens against foreign currencies that you utilize to manage your business? These are things that you need to understand. So you got to identify them, you got to quantify them, and then you got to assess the risk. The level of exposure through this analysis or doing analytics can help you understand the size of the exposure if things move. And think of it in terms of more of a statistical analysis. And we think about standard deviations and your test hypothesis. And is it true if something happens? Is it true that it would impact that particular item you're looking at positively or negatively? So you want to understand both ways. You want to understand, is there more risk on one side or the other if something happens? So risk assessment of those exposures and understanding what that is important, because that will help you identify the risks that you want to try to hedge. And once you understand that, you can execute your plan on hedging options that will help reduce the uncertainty of movements in interest rates and foreign currency. And once you've done that, you got to monitor. So you got to monitor the exposure that you're hedging. And this has got to be done over a period of time, so you got to track it. And this process is circular in nature because you may reduce or increase exposures depending on what's going on in your business. There are a variety of hedging tools you can use for interest rates and foreign currency. And some of those include forward contracts, which will lock in exchange rates or interest rates for future payments or receipts. You can do vanilla or structured options, which retain protection while creating the ability to participate in positive movements of foreign currency or interest rates, meaning it moves in a favorable way for your existing position. You can also enter into cross-currency swaps or interest rate swaps, in which you swap out currencies, one for another, or interest rates, such as fixed for floating or vice versa. You can also have natural hedges, which are the operations of your business. If you're a global company and you're doing business in different regions, you would utilize inflows and outflows with the same entity using same currency. So your currency offsets inflows and outflows. And then there are layered or rolling hedges. And when we think about rolling and layered hedges, you can think of a layered hedge being multiple hedges that you engage in to kind of smooth things out over a period of time, where a rolling hedge is you have an existing position and you're updating that position. You're closing out when the hedge matures, and then you're re-entering into a new hedge. So these are tools you can utilize to help protect yourself for risk associated with both foreign currency and interest rates.
Okay, so let's talk about the relevance of AI with this now. What are the foundations of AI that can be used to manage FX and interest rate risk?
Some of the foundations of AI are around computing power. We see that data continues to grow at a pretty good pace, but the good thing is that computing power is outpacing the growth of data. So it's doubling every year and a half, while data is doubling every 2 years. So computing power is outpacing, which is a good sign, especially as we analyze more data and we integrate systems with more information to make decisions. Also, connectivity is getting better with APIs and the ability to get real-time information. You can have straight-through processing with secure connectivity. Managing big data has become easier with these tools, real-time and computing power. And the other side of this is that on the human side of things, treasury teams are getting educated and coming up to speed on AI. There's still a lot of growth potential in terms of how AI is used within organizations, but personal life, certainly people are using AI more and more. Within organizations over the next 12 months, we're going to continue to see an increase in the use of AI. And so when we put all this together, what does that mean from a general standpoint? What are the components of AI that could help with managing interest rate and foreign currency risks? One area is machine learning. Machine learning is a predictive analytic tool, so it can help you understand movements with historical data, patterns, and help you recognize those patterns and improve your forecasting over time, because forecasting is really important when you're trying to manage that interest rate foreign currency risk. The other area is around generative AI, which creates new context based on patterns that have been learned. It will help you with policies and reporting, so monitoring exposures to foreign currency and interest rates. And then agentic AI is a tool which runs autonomously and executes tasks or focuses on goals. And so these tools can help with detecting things that are out of place and resolving reconciliations or matching. It can automate your foreign currency and interest rate hedges. It can help automate things so it can automatically engage in executing some of the positions, the hedging positions that will be more effective for managing risk. And then another area I wanted to cover was around some of the changes in generative AI. So we're seeing that it's taking unstructured data and turning it into structured. This meaning you get a lot of data points, a lot of information. It may not be clear to you what that information is telling you. Generative AI is able to help you understand what that is in a more structured way. Setting up your data for analysis or forecasting is super important. So it bridges gaps. It helps align systems. It also gives you that real-time insights that we talked about earlier, which can be real beneficial to manage FX and interest rates. So the predictive capabilities of AI are a significant step forward for organizations, and you can do it at cost reduction, and it can be really efficient. So we see that AI is going to become more integral in managing these risks by utilizing these tools that I talked about.
Okay, so as we wrap up, how will AI help in analyzing and managing risk?
Well, I talked about its ability to kind of monitor. It can also predict. In particular, it's going to help significantly with forecasting, but also this idea of automating parts of your monitoring process, but the hedging process itself, being able to execute on hedges based on parameters tied back to policies that you have in place. So you can make it full circle in a way. It identifies the risks, identifies those exposures. So being able to understand what those risks and exposures are, help you to better position yourself from a hedging standpoint and manage the risk, not only in the short term, but also in the long term when you have long-term considerations as well. You can also use AI to help manage or evaluate counterparty exposures. Counterparty risk can have an impact on interest rates and FX. Depending on what's going on out there, counterparty risk can come in many forms, but it does have an impact. When we think about FX and interest rate exposures, AI can take those actions based on parameters that are set up. It can be automated, and that way you can become a lot more efficient in terms of what's happening. You don't have to have more manual intervention or have a human touch to manage all the risks. It doesn't mean necessarily that you have it manage everything. It can be very pointed to specific activities. You can limit it that way, and you can still have the human intervention to manage the risk while using the AI tools. So it can evaluate and recommend decisions around FX interest rate exposures, and you can stop it there and not have it do automated transactions. You may want to do that for certain parts of your business, and others you may be more willing to accept what that AI will do for you and just have it automated. So we think about what this AI predictive analytics is to help you with currency and interest rate fluctuations, data analysis and integration, whether it's key economic indicators, interest rates, foreign currency, geopolitical events, things that are going on within a country or on a global basis. The other areas around the machine learning models that we talked about, how it can identify patterns. It can also identify correlations to historical data. And then when we talk about correlations, it can be on both sides. It can be data points that are highly correlated, meaning they move together, or they're not correlated at all, and they have one moves and the other doesn't do anything, or they can be negatively correlated where one goes up and the other goes down, so they have an opposite impact on each other. So understanding correlations can be really important when it comes to FX and interest rates and data points that might impact them or have no impact. I did mention scenario analysis, the ability to do scenarios. So sensitivity, meaning you adjust a key variable or driver that could impact interest rates or foreign currency. You adjust that, see what the impact is. Scenario analysis is different in the idea of when we do a scenario analysis, it's, hey, I think this might happen. And you think, okay, central bank is going to, let's say, increase interest rates. Let's see what happens if they increase interest rates by 50 basis points, 100 basis points. What's the impact? What does that mean to me? Those are the kinds of things that scenario analysis can do. And so instead of taking a particular driver and moving it, it may be more than one driver. It's interest rates, it's something else, it's something else. It could be 2, 3, 4 things that are changing, and see what that impact is or has on your foreign currency and your interest rates. The other thing is getting real-time data, monitoring on a real-time basis. This is, huge advancement for organizations today. Having information quicker can help make better decisions. And so that is, instead of being reactive, you're more proactive in that realm, being able to alert other people within the organization of potential significant change, what those trends might be, and what decisions you're going to take to manage those risks. And another area is around risk assessment. AI can help you with the risk assessment when we talked about monitoring, but it can also help you with compliance. Are you within the policies that you set? Are you compliant within any of those hedging mechanisms? Are you staying within the appropriate definition of what a hedge is? That's important to organizations. So managing risk, the framework that you put in place, setting up what level of tolerance in your policy, having positioning and quantification of what movements might be, what your exposures are, being able to calibrate and hedge effectively, taking that action, executing, super important. And at the very end, report on it. You learn from what you have been doing, what the current position is, and what you think the future position is going to be. And AI can help you with all this. So I think those are really important factors in terms of managing risk and how AI, you can use the tools that I mentioned. It can help you set this up on an automated basis and make better decisions and manage the risk more effectively.
Great. Thank you, Paul.
Thank you. I appreciate being on this podcast again.
And thank you for listening to this episode of the Treasury Update podcast. This is your host, Brian Weeks. We'll talk to you next time.
You've reached the end of another episode of the Treasury Update podcast. Be sure to follow Strategic Treasurer on LinkedIn. Just search for Strategic Treasurer. This podcast is provided for informational purposes only, and statements made by Strategic Treasurer LLC on this podcast are not intended as legal, business, consulting, or tax advice. For more information, visit and bookmark strategictreasurer.com.